A lot of dental practice owners believe this. If I just produce more, everything will improve. More patients, more production, more collections. But here is the uncomfortable truth. Growth in collections does not automatically increase profits. In fact, it may be that revenue increase could lead you to a decrease in profit margin. Today, I'll show you why revenue growth alone doesn't fix profit problems and what actually does. Let's say your practice grows from $1.2 million to $1.5 million. That sounds like success, but then you look at your bank account and there's not much more left over. Why? Because revenue growth often comes with expense growth. You hire more team members, you may have overtime increases, dental supplies increase, lab costs increase, advertising and promotion increases. If expenses increase at the same pace or faster than your revenue, your profit margin does not improve. It might even decrease. Growth without control creates pressure and not profitability. If you haven't met, my name is Bhola, and we specialize in bookkeeping and financial reporting for dental practices. We help practices get clean, updated financials so ownership can make better business decisions. On this channel, we focus on clear numbers, better decisions, and higher profits for your dental practice. Now, let's look at a healthy single location dental practice as a reference point. Typical averages as a percentage of income are as follows. Employee expenses, 31%, dental supplies, 5.58%, lab at 5.86%, and so on and so forth. An average single practice often operates around a 35% EBITDA margin. Group practices typically operate closer to a 17% EBITDA margin. Now, here is the key. If revenue expenses increase by 20%, but employee expenses increase from 31% to 36%, your profit margin can decrease, even though production increased. Revenue is the top line. Profit is what remains after controlled expenses. If expense percentages increase, revenue growth alone will not protect your EBITDA margin. Here is why revenue growth often fails to fix profit. Number one, payroll increases faster than production. As practices grow, they often add assistants before schedules are full, increase hygiene hours without matching production, pay overtime instead of adjusting staffing models. If employee expenses move from 31% to 35% on a $1.5 million revenue, that difference is $60,000 annually. Revenue increased, but profit margin decreased. Number two, dental supplies and labs scale with production. Dental supplies on an average are around 5.58%. Labs average around 5.86%. If systems are tight, these percentages increase as volume increases. For example, at $1 million of collections, 5.58% dental supplies equals $55,000. At $1.5 million, if controlled at 5.58%, it should be $83,000. If uncontrolled, they can go up to 8% or more, which is $120,000. That difference alone significantly impacts EBITDA margin. More procedures without cost discipline reduces profitability. Number three, fixed costs stay stable. Variable costs increase with production. Facilities expense and rent expense are more stable, but variable costs increase with growth. Payroll expense, dental supplies, lab, associate pay. If variable costs increase faster than revenue, profit margins shrink. Growth amplifies inefficiencies. Number four, owners stop watching percentages. When revenue increases, many owners relax. They assume we're growing, so we're doing fine. But percentages tell the real story. If employee expenses increase, advertising and promotion increase, overhead expenses increase even slightly, those small increases add up. Profit doesn't disappear all at once. It decreases gradually through small percentage shifts. Number five, EBITDA margin is what matters, not just revenue. If you are a group practice, 17% EBITDA margin is common. If you are an average single dental practice, you may be near 35% for EBITDA margin. If revenue increases but EBITDA margin decreased from 35% to 28%, you did not improve profitability. You increased workload, you increased stress, you increased operational complexity, but you did not increase true profit. Now, let's compare two scenarios. Scenario 1, revenue growth without cost control. Year 1, revenue $1.2 million. EBITDA margin 35%, so EBITDA is about $420,000. Year 2, revenue grows to $1.5 million, but employee expenses increase to 35%. Dental supplies increase to 7%. Lab increases to 7%. New EBITDA margin drops to 28%. 28% of $1.5 million is $420,000. Same EBITDA amount. More work, more stress, no additional amount added to EBITDA. Scenario 2, revenue growth with cost discipline. Year 2, revenue increases to $1.5 million, but employee expenses still stay near the 31%. Dental supplies percentage still stays close to 5.6%. And lab costs as well stay close to the 5.8%. EBITDA margin stays at the 35% because we control costs. 35% of $1.5 million is $525,000. That is a $105,000 increase in EBITDA amount. Same revenue growth. However, there was much better expense control, and hence there was much better increase in profits. Here is what I would take away from this video. Revenue growth alone does not fix profit problems. If expense percentages increase alongside revenue, your profit margin will not improve. To truly increase profit, monitor employee expenses, control your dental supplies expense, track lab costs, review expenses monthly, protect your EBITDA margin. Growth should increase profit, not just production. And the only way that happens is when revenue grows while expense percentages stay controlled. Because at the end of the day, revenue is a vanity number. Profit is the true king. If your revenue is increasing, but your profit margin or EBITDA margin is not improving, it's time to look at your expense percentages. Revenue is powerful, but only if the expenses are being controlled. Clear numbers, better decisions, and higher profits for your dental practice. I will see you in the next one.